Principles of insurance. Insurance is defined as a contract, which is called a policy, in which an individual or organization receives financial protection and reimbursement of damages from the insurer or the insurance company. At every basic level, it is some form of protection from any possible financial losses. The basic principles of insurance is that an entity will choose to spend small periodic amounts of money against the possibility of a huge unexpected loss. Basically, all the policyholder pool their risks together. Any loss that they suffer will be paid out of their premiums which they pay. There are no certainties or guarantees in life. There is no guarantee that the business will not suffer an unexpected loss or damages. So, while we cannot protect our interest against all risks, we can opt for some insurance. Let us take a look at concepts of insurance and functions of an insurance company. Some functions of insurance company. The main function of insurance is that eliminates the uncertainty of unexpected and sudden financial loss. This is one of the biggest worries of a business. Instead of this uncertainty, it provides the certainty of regular payment, that is, premium to be paid. Insurance does not risk the risk of loss or damage that a company may suffer, but it provides a protection against such loss that a company may suffer. So at least the organization does not suffer financial losses that their daily functioning. In insurance, all the policyholders pool their risks together. They all pay their premiums, and if one of them suffers financial losses, then the payout comes from this fund. So, the risk is shared between all of them. In a lot of cases, getting some form of insurance is actually required by the law of the land. Like, for example, when goods are in freight or when you open a public space, getting fire insurance may be a mandatory requirement. So, an insurance company will help us fulfill these requirements. The pooled premiums of the policyholders help create a capital for the insurance company. This capital can then be invested in a productive purposes that generate income for the company. Principles of insurance. As we discussed before, insurance is actually a form of contract. Hence, there are certain principles that are important to ensure the validity of the contract, but parties must abide by these principles. Utmost good faith. A contract of insurance must be made based on utmost good faith. A construct It is important that the insured disclose all relevant facts to the insurance company. Any facts that would increase his premium amount or would cause any prudent insurer to reconsider the policy must be disclosed. If it is later discovered that some much facts are hidden by the insurer will be within his rights to void the insurance policy. This means that the insurer must have some pecuniary interest in the subject matter of the insurance. This means the insurer need not necessarily be the owner of the insured property, but he must have some vested interest in it. If the property is damaged, the insurer must suffer from some financial losses. Insurances like fire and marine insurance are contracts of indemnity. Here, the insurer undertakes the responsibility of compensating the insured against any possible damage or loss that he may or may not suffer. Life insurance is not a contract of indemnity. Subrogation. This principle says that once the compensation has been paid, the right of ownership of the property will shift from the insured to the insurer. So, the insured will not be able to make a profit from the damaged property or sell it. Contribution. This principle applies if there are more than one insurers. In such a case, the insurer can ask the other insurers to contribute their share of the compensation. If the insured claims full insurance from one insurer, he loses his right to claim any amount from the other insurance. Proximate cause. This principle states that the property is insured only against the incidents that are mentioned in the policy. In case the loss is due to more than one such peril, the one that is most effective in causing the damage is caused to be caused. Now, we are going to learn some few lines on the Indian insurance. India's economy has been in a boom for the last 2 decades. There has been increased manufacturing and financial activities. This, in turn, has triggered a rapid growth in the insurance sectors as well. In the year 2000, the authorities allowed private companies to be a part of the insurance. Today, there are 13 companies in life insurance and 13 in general insurance. The most prominent one is of course LIC, and then there are other major players like New India, Tata AIG, Bajaj Allianz, ICICI, Lombard, etc. Principles of utmost good faith, principles of insurable interest, principles of indemnity, principles of contribution, principles of subrogation, principle of loss minimization, principle of causa proxima, the nearest to cause. Now we are going to learn the first feature, principles of utmost good faith. Principles of utmost good faith. The principle of utmost good faith is a very basic and the first primary principle of insurance. According to this principle, the insurance contract must be signed by both parties, that is, the insurer and the insured, is an absolute good faith or belief or trust. It applies to all types of insurance contracts. Principles of insurance interest. The principle of insurable interest states that the person getting insured must have insurable interest in the physical existence of the insured object, gives him some gain, but its non-existence will give him a loss. In some words, the insured persons must suffer some financial loss by the damage of the insured object. Principles of indemnity. Indemnity means security, protection and compensation given against damage, loss or injury. According to this principle of indemnity, an insurance contract is signed only for getting protection against unpredicted financial losses arising due to future uncertainties. Insurance contract is not made for making profit, else its sole purpose is to give compensation in case of any damage or loss. Principles of contribution. Principles of contribution is a corollary of the principle of indemnity. It applies to all contracts of indemnity if the insured have taken out more than one policy on the same subject matter. According to this principle, the insured can claim the compensation only to the extent of actual loss either from all insurers or from any other insurance. If one insurer pays full compensation, then that insurer can claim proportionate claim for other insurance. Principles of subrogation. Principles of subrogation is an extension and another corollary of the principles of indemnity. It also applies to all contracts of indemnity. According to this principles of subrogation, when the insured is compensated for the losses due to damage to his insured property, then the ownership right of such property shifts to the insurer. This principle is applicable only when the damaged property has any value after the event causing the damage. The insurer can benefit out of subrogation rights only to the extent of this amount he has paid to the insured as compensation. Principles of loss minimization. According to this principle, the insured must always try his level best to minimize the loss of his insured property in case of uncertain events like a fire, outbreak or blast, etc. The insured must take all possible measures and necessary steps to control and reduce the losses in such a scenario. The insured must not neglect and behave irresponsibly during such events just because the property is insured. Hence, it is the responsibility of the insured to protect his insured property and avoid further losses. Principles of causa and proxima. Principle of causa proxima, or in simple English words, the principles of proximate or nearest cause, which means when a loss is caused by more than one causes, the proximate or the nearest or the closest cause should be taken into consideration to decide the liability of the insurer. The principle states that to find out whether the insurer is liable for the loss or not, the proximate and the remote must be looked into. Insurance policies are contracts that provide people with financial security and protection from future uncertainty. In order for the relationship between the insurer and the insured to work, however, there are certain important principles that must be upheld. Read on to learn about the principles of insurance contracts. The principles of indemnity ensure that an insurance contract protects you from and compensates you for any damage, loss, or injury. The purpose of an insurance contract is to make you whole in the event of a loss, not to allow you to make a profit. Thus, the amount of your compensation for a loss is directly related to the amount of loss that you actually suffered. Contribution is a similar principle to indemnity, and it applies to situations where you have more than one insurance policy for the same asset or entity. For example, imagine that you own a truck that is insured by both company A and company B. If another driver hits your truck and it will cost you 5,000 to fix it, you can submit your claim to company A, company B, or to both companies. If company A compensates you fully, then it can claim a proportionate contribution from company B. However, if both companies compensate you fully, you can't keep the full amount and turn a profit because this would amount to an unfair windfall. Insurable interest. The insurable interest principles requires that the owner of a particular insurance policy have an ownership interest in the particular subject matter of interest in the particular subject matter of the insurance policy. For example, the owner of a hot dog cart has an insurable interest in the cart because he owns it and is hearing money from it. However, if he sells the hot dog cart, this means he will no longer have an insurable interest in it. Creditors also have an insurable interest in debt. The absence of an insurable interest can make the insurance policy in question null or void. Thank you.